Hi, this is Professor Nugent, and this is Chapter 14, Options, Puts, and Calls that we're going to talk about today. And we're going to learn about the basic nature of options, and we're going to talk about how they work as investments. We're going to describe the option market, option provisions, strike calls, expiration dates. We're going to explain how puts and call options are evaluated in the marketplace. We're going to describe the profit potential for using options. We're going to explain your loss exposure, writing options, covered calls, leaps, market indexes. Uh, so let's get right to it. So an option is another type of financial instrument that the value of it's based on a financial asset. So the asset represents a financial claim to an issuing organization. In our case, we're going to be mostly talking about stocks. So we're going to talk about stock options. And the option, it gives you the option to buy the stock at or sell the stock at a certain price for a specific period of time. Sort of like if I said to you, I'm going to give you the option of buying the new Xbox, and you have 10 days. This option is good for 10 days, and you can buy it for $600 from me. So for the next 10 days, you can buy the Xbox for $600 from me. And for that, I'm going to charge you $10 for me to sell you the right to buy it from me for $600. Now you may say, well, why would I do that? Because I can get it for less. Well, you never know. Maybe there's a shortage. They're selling for $1,000 on eBay, and suddenly my option looks like a good deal. You can exercise it. Maybe you put in this option, and I give you the option to buy it from me for $600 between November 15th to December 20th. So that way, if there's a Christmas rush and all the stores sell out, you still have me as an option to buy it from. But just a poor example, I guess. All right, so types of options. We have puts and calls, rights and warrants. Those are four types. We're mostly going to be talking about puts and calls. Puts are like selling short, calls are like buying long. Now, options are called derivative securities because they themselves are not an asset. Their value is derived from another asset like gold or currency or bonds or stocks. And the value and the price behavior from the underlying asset is what creates the volatility in the option. And puts and calls can be traded on stocks, stock indexes, exchange traded funds, foreign currencies, debt instruments, commodities, and financial futures. Now, if you own puts and calls on a stock, you have no voting rights, you're going to receive no dividends, you have no privileges of ownership, you receive no interest on the bonds. So you don't actually own the asset. Get this through your head. You do not own the stock or the gold or the currency. You just have the option. You own the option. You don't actually own the asset. The option is like a promise. So you're buying a promise, not an asset. But the promise is tied to some tangible responsibilities. So, but the option, when you buy the option, it allows you to leverage. So the option is going to be a fraction of the cost of the stock. So for example, if you bought 1,000 shares of a $25 stock, you'd be paying $25. But if you bought 10 contracts, each contract is valued at 100 shares, so that'd be 1,000 shares. So if you bought 10 contracts of the same stock, it may only cost you $2,500 to buy the option contracts associated with 1,000 shares. And it's basically like owning 1,000 shares. So it's a lot cheaper. So instead of spending $25,000, you can spend $2,500. Now, the options aren't always the same price. The prices fluctuate. And so as the stock value changes, the option value changes as well. And puts and calls are created by individual investors, not organizations, not businesses. So IBM does not create options for IBM stock. Someone like me, I might own IBM stock and I can create options for IBM stock that I could sell to somebody else like you. So individual investors create options, not any companies. Okay. So if you're an option buyer, if you want to buy an option, that means you're buying the right to buy the stock at a certain price If it's a call option, you're buying the right to buy the stock at a certain price. If it's a put option, you're buying the option to sell the stock at a certain price. And the underlying asset is going to be, you agree on a fixed price that you're going to be able to buy or sell the stock at, and that's called the exercise price or strike price. And that's only good for a given period of time. It's not indefinite. And you have the right to acquire, but you don't have to acquire, but you have the right to acquire this stock or sell the stock at a specific price for a specific period of time. And you have to pay a fee for that right. So if you're buying an option, you pay basically money to purchase it. And that's what we call the option price or a premium. Now, as a buyer, you don't have to option. You don't have to use the option. You can buy it and just let it expire, like a gallon of milk. You can buy a gallon of milk and you have the option to drink it, or you have the option to let it expire. That's up to you. If you let it expire, you just wasted the money buying that gallon of milk. And if you drink the milk, then you didn't waste your money. If you're a seller, I usually refer to this as a writer because it's less confusing. So if you're an option writer, you're the one writing the option that someone else is going to buy. So you're sort of like the option store. So you can create your own option store and write a bunch of options and have people buy them for you, and they'll pay you for these options and you'll make money. But you, as the writer, have the obligation. So you're going to have to sell that stock to that person, or sell that stock short for that person if they want you to. So once you sell an option to somebody, now you're locked into a promise. So an option writer has to deliver on his promises if the option buyers decide to exercise the contract. So the buyers can walk away scot-free. They don't have any obligations. The sellers or the option writers, they have all the obligations. So you can't walk away. You have to fulfill the contract that you established if they want you to fill it. So puts and call options trade in the open market a lot like stocks. So there are stock exchanges, there are option exchanges. And the value of puts and calls are derived from the underlying assets they represent. Now, other things that will influence the premium you pay for an option is, definitely going to be the price of that you're agreeing, the strike price, and the time before it expires. Now, this is important because an option that's going to expire in 10 days is not as valuable as an option that's going to expire in 10 months. So the longer period of time you have in the option, the more chances you have of making money with it. So that's why they're more expensive. And there's something called, if the strike price is at $30 and you're buying the right to purchase the stock at $20, the $10 difference between what you're paying to purchase it at and what the actual price of the stock is going to be incorporated in that stock premium. Okay. Now, what's great about stock put and calls is that they allow you to leverage. So you only have to put down, say, maybe 10% of the value of the underlying asset. So if you wanted to buy $100,000 worth of Google stock, you would probably only have to pay $10,000 in premium to have the equivalent of $100,000 worth of Google stock. And this premium you pay is, as an option buyer, that will limit your losses. So you can get this great amount of exposure with a very small amount of actual potential loss if the stock doesn't move in your direction. So if the value of the underlying asset goes up or down, depending on what option you bought, then you make money. Now, the disadvantages of puts and calls is buying an option, you're not going to receive any interest or dividends. The options do expire, and when they expire, they're worthless. And options are risky. The option premiums are generally not in your favor, so it's the probability of making money with a contract is not in the buyer's favor, it's in the writer's favor. So, and if you are the option seller, or what I call the writer, the exposure to risk is unlimited as the writer side, but not as the buyer. Let's talk about how a call option works. Okay, you want to buy a call option. It's going to give you the right, as the buyer, the right to buy underlying stock at a specific price for a specific period of time. So as the buyer of the call option, you want the stock price to go up. If you're the one writing the call option, you're hoping for the stock price to be flat or go down. Now, if the price of the underlying asset goes above the strike price, that's good. The option holder, as a buyer of the option, if the stock price goes above the strike price, you are going to want to purchase that stock and sell it at the higher price to make a profit. If you're the option writer, you must sell the stock at the strike price, which means you're going to lose money. So now, one way as a writer you can prevent huge losses is you could write what's called a covered call, which means you own the stock first and then you write the options on it. So if the stock goes from $10 to $1,000, you don't have to go and buy the stock at $1,000. You pre-bought it at 10 and then wrote the call option someone else purchased, so you can just physically hand the stock over. If you make a naked call, then you don't own the stock and you have unlimited risk as a stock option writer. Okay, at this point, if you feel like I'm going too fast or you're not really understanding a lot of this would be a great time to pause this YouTube presentation and go up to the textbook and start reading. Read the textbook, get a general idea and sense of what these options are, and then come back and restart this lecture or continue from here. Okay, so if the price of the underlying call option asset goes down, the buyer will let the option expire because it's worthless. You wouldn't exercise an option that's out of the money. And the seller would keep the premium, he'll make a profit, and if he had the stock already, he still keeps it and could write another option later for it. Now, so as an example, and we're going to do these, a few of these examples, but so if we assume the market price of a stock is $50, an investor buys a call option which grants the rights to purchase 100 shares of stock at $50, and the call premium is going to be $500. So if the market price stock goes up to 75, the investor will exercise the right to purchase 100 shares at 50, and then the investor can sell his shares at $75 in the market. So the profit would be the market price, the $75 minus the strike price, 50, times 100 shares, because one contract's 100 shares, minus the premium price, which is 500. So in this case, the profit would be $2,000 for the call option buyer. Now, the person who wrote the option, also known as the seller, they're going to have a loss. So their loss, that we just flip the market price and strike price. So it's strike price minus market price times the outstanding shares plus the premium they earned, and you'll see that they lost $2,000. So this is what we call a zero-sum game. Whatever money the call purchaser makes, the call writer loses. So it's the exact same amount of transfer of money. There's no loss difference between the two. And that's why I call it a zero-sum game. Now, the leverage here is, we made a $2,000 profit and we only invested $500. So that's a 400% return. That's really good. If we were to buy the stock outright, we would have paid $500,000 and made a profit. We would have paid $50,000 and made a profit of $2,500, which is only 5% return. So you can see how the same $25 increase in the stock price can get you a 400% return versus a 5% return for basically owning 100 shares of the stock. Okay, so the market price of the common stock is $50. An investor buys a call option to purchase 100 shares of stock at $50 per share, and the premium's $500. So what if the market price stock goes down $25 a share? The investor will just allow the option to expire, like that gallon of milk, and he'll lose the $500 premium he paid to buy the option, and that's it. Now let's talk about put contracts. Now, a put option is like a short sell. So if you're going to buy a put option, you're buying the right to sell a stock at a specific price for a specific period of time. So the buyer of the put option wants the price to go down, while the seller of the put option wants the price to remain the same or go up. So if the price of the stock goes down below the strike price of the put option, the owner is going to want to exercise the contract, which is going to enable him to sell the stock short and repurchase it can sell the stock at a strike price and repurchase it at the current price and make a profit. Now, if the stock price goes up, the buyer is just going to let that put contract expire because there's no value in it. So, here's a similar example. Assume the market price of the stock is $50. The buyer buys a put option, which gives them the right to sell 100 shares of stock at $50 per share, and the option premium is $500. So if the market price of the stock goes down $25, the investor will purchase 100 shares of stock in the open market for $25 each. And then the investor will exercise his right to sell those stocks to the put seller for $50 each. So basically, I'm going to go and buy it for $2,500 and then sell it. I'm going to buy it for $2,500 and sell it back to the person who wrote the put contract for $50 a share. So the profit would be strike price minus market price minus the premium I paid. So it'll be $50 minus $25. So it's $25 times 100 shares, which is $2,500 minus the $500. That is my premium. It leaves me with a profit of $2,000. Now the person who wrote this contract, the seller who wrote the contract, they're going to have a loss. So we just flip the strike and market price for them. So if you're the one who wrote the contract, you're going to have to lose $2,000 because the stock price went down. Okay, so assume the market price of the common stock is $50, and the put option allows you to sell 100 shares at a strike price of $50 with a purchasing. The cost of buying this contract is $500. Now, if the market price goes to $75 a share, there's no value in this contract. You would just let it expire, like the gallon of milk, and you would lose $500. Okay, now there are stock markets, there are option markets. So the over-the-counter option market is used by most institutional investors. So if you the listed options exchange, Chicago Board of Options Exchange, CBOE, is the biggest. It's created in 1973, and it trades puts and calls, futures and swap contracts. And it works a lot like a stock exchange, but they specialize in these derivatives or option contracts. And let me just correct myself. I'm sorry. The Chicago Board of Options Exchanges just trade as options. They don't trade futures. That's a different exchange. Sorry about that. Just remembered. Anyway, it's like a stock market. It's pretty conventional, and it's standardized. What happens is these option markets standardize the expiration dates, the exercise and strike prices, and they help reduce costs because they create a organized exchange where you could trade standardized options. And this helps to create a much bigger market. Before an options exchange, people used to have to get together with a lawyer and draft contracts and do an option contract independently against two people and a lawyer working together. So here the option exchange is greatly standardized and then made the option contracts available for all to invest. So billions of options contracts are traded each year. Options on stocks are definitely the most popular, and 90% of the contracts are stock option contracts. Now here are the key elements of a stock option, and there's generally a lot of questions in the test about this type of thing. Strike price. This is the price you agree to buy or sell the stock at. And the conventional over-the-counter options, they have strike prices. And the listed standardized prices and incremental is determined by the price of the stock. So strike price is just the price you agree to buy or sell the stock at the contract. It's usually not the current stock price. It's some other price that you're agreeing to buy or sell it at. And depending on how valuable this price is how much the contracts are generally worth. The expiration date is the date the contract expires, where it's no longer good, like the gallon of milk. It doesn't last forever. So here's like quotations for listed stock options, and you could see that this is the date they're going to expire. This is the last price of it, and then you have the change for the day. They trade as a bid and ask, just like a stock. The amount of volume today, the open interest, the amount of contracts created, and these would be the calls. The other side are the puts. We also call this bid and ask price is also known as the premium. Okay, so as far as expiration dates, they happen in 3 cycles: January, April, July, February, May, August, November, and March, June, September, December. I'm sorry, the first one's January, April, July, October. So they're 3 cycles of 4 months each. Um, so your option on your stock may be in 1, 2, or 3 of these cycles. So it could be that your option, you have contracts every month, or only 8 of the 12 months, or 4 of the 12 months. So it just depends on how popular the option is. So usually these expiration dates are no longer than 9 months. So 9 months or less are the typical expiration dates. If they're greater than 9 months, we call them leaps, and they're long-term option contracts, and they're much more expensive. And these contracts always expire in the third Friday of the expiration month. So the third Friday in January, or the third Friday in April, or the third Friday in May. It's always the third Friday of the month that these contracts expire. Now, the option premium, we call this the price. This is what you're paying for the contract. So this is what you pay to buy the put or call option. And the option premium's made up of really 2 pieces of information. The intrinsic value, which is really the difference between the strike price and the stock price. And then the time premium, how much time there is before the contract expires. So your intrinsic value, the actual value between the strike price and stock price, and then the time premium. The bigger amount of time you have, the more of a premium there will be. So the intrinsic value of a call option equals the difference between the market price of the stock and the strike price of the option. Or 0, whichever is greater. It's never negative. Intrinsic value is never negative. It's either 0 or a positive amount. So suppose a call option has a strike price of 50. The underlying stock has a price of 75. The intrinsic value is 25, because it's telling you that you can buy it at 50, and if the stock price is at 75, you make a $25 profit. So that's why there's a $25, intrinsic value. If the underlying stock price was $25 and you have the right to buy it at 50, the intrinsic value is 0, because there's no value there, and it's never negative. For a put option, it kind of works in reverse. So if we have a $50 strike price and the underlying stock is currently at $25, the put value, intrinsic value, is $25, because you can sell it at 50 and buy it back at 25. If the stock price happened to be $75, there would be no value. There's no value at selling it at 25 and having to repurchase it at 75. So 0 intrinsic value there. Here's a graphic chart of what I've been talking about. So if you have the price of the, this is the price of the stock, and here is the strike price, or the exercise price is at 50. So what we're looking at when we're trying to calculate our profits, if the stock price is 50 and the exercise price is 50, there's no intrinsic value. And there's definitely, at this point, where the stock price meets the exercise price for a call option, the loss is whatever the premium is you paid. So if you paid a $500 premium, once you have the stock goes up, say $5, now you've at the break-even point. So you can buy the stock at 50 and sell it at 55, which will pay, since it's one contract is 100 shares, that profit will pay for the $500 premium, and you'll be finally at break-even. So every dollar it goes above 55 is in the profit zone. And the higher the stock price goes up, the more profit you make. And the put option is sort of reciprocal. So you want the stock price to go down. So once the stock price goes down $5 from your starting point, where the stock price, if the exercise price is 50 and the stock price is 45, you're at break even if it's a $500 premium. If the stock price goes to 40 or 35 or 30, you keep making money as the stock price goes down. So there's a limit to how much you can make on a put. When the stock price reaches 0, then that's the maximum profit you can make. But in a call option, there's unlimited profit to be made, because there's no ceiling on how high the stock price can go. Now we have some terms for the valuation of stock options. We have in the money, which means that for For a call option, the strike price is lower than the market price, and for a put option, the strike price is greater than the market price. And we have out of the money. So this is when their strike price might be, for a call option, your strike price might be 50, but the stock's currently at $40. So it's out of the money. So most options are purchased out of the money because they're the least expensive, and you're hoping that the stock price will become in the money at some point. Now, here's another look at options. So if we look at these quoted option prices, and we could look at the fundamental value, and which is also known as the intrinsic value, is also known as the fundamental value, and the time premium, we could see that for the $65 contract strike price in the call contract, if it's going to expire in March, the premium is $7.75. $6 is fundamental value, and $1 is time value. Now, this is the stock price. So stock price is $71.75. The strike is at 60, and the difference between $71.75 and 60 is the $6.75. So $1 would be the time premium. If we go out to June, we still have the same intrinsic or fundamental value because the $71.75 minus 65 is still the same amount, but we have a bigger time premium. So the total premium is $9.75, but the time premium is increased because it's goes out to June. Now, if the strike price increases, we get a smaller. We're going to get a smaller fundamental value. So here we have, as you can see, it's only $1.75 is a difference in the fundamental value, but the time value is a little bit larger, and that's not so uncommon. So these are just, and I would suggest go to Yahoo Finance to, I'll show you that in a second. So if you go to Yahoo Finance and you click on a stock like Google, and then you click on, let's see, these options are blacked out here. Let's go back. Let's click on, say, Apple. Then you click on options, and then you get your option contracts. So here you could say, I want to see the May contracts, and you click here, and it'll pull up the May contracts. So you have all the months up here, and you can select the month you want your contract in. And then these are the actual symbols. The symbols are rather long. You got the strike prices over here. You got the last price it traded at, the bid and the ask, and the change, the volume, the open interest. So here you can easily, and we could see that. If we look at, let's look at the ask price, and you'll see that as the strike price, see, if I could buy it at 280 and sell it at 566, that's a $287 value. So as the strike price goes higher, you could see that this is strike price here. You can see that the price of the option starts getting lower. So if I'm going to go up to, let's see, I want to strike an out of the money strike at 560, the premium is going to be 14. But I do, actually, what was it trading at? 566, so that's still in the money. Okay. Actually, when it goes from yellow, these are all in the money. When it goes to blue, these are out of the money. So you could see that the in the money contract is $11, but if I go from 65 to 67, suddenly the out of the money contract's a lot less. So the out of the money contracts tend to be cheaper. So this is how you could use Yahoo Finance to go and check the option values and contracts for any stocks that you may be interested in. Okay, back to the lecture. So the pricing of stock options works on, basically the basic formula is the intrinsic value and time value. But there is this Black-Scholes model for valuing valuing stocks options, but it only works for what we call European stock options, which have you can only enact the trade on the expiration date. Where American stock options you can activate at any time. But the model does state the options price is a function, of course, of the strike price, expiration price, the price of the stock, the risk-free interest rate, and the volatility of the stock. All these five factors make up the actual price of any option contract. So the strike price is obvious because that's the price you can buy it at. The expiration date is obvious because that gives you the time limit for the contract. The price of the stock is related to the stock price. So these two, the difference between these two and the direction between these two helps determine the price of the option. The risk-free rate has a small impact, not great, and the volatility. The more volatile the stock is, then the more volatile the stock, the more the higher the price will be because of the volatility means there's more of a chance of making money. So people use stock options to buy for speculation, just to make money, to hedge their current positions, the right options to make some additional income, or the spread options that to enhance returns. So if you're going to use speculation, you could just go, instead of buying the stock, you buy the option that represents the stock, and you will be risking less money. So that's a possibility. And this is just sort of an example of speculating and the returns you can make from a $40 strike price versus a $50 strike price. So if you want to hedge with a stock, basically, if you own 1,000 shares of Google and you're afraid the price is going to go down, you can buy a put option, 10 put contracts, which equals 1,000 shares. So if the stock price does go down, your real stock will lose money, but your put contract will make money. So you can hedge yourself and cover your position by having these option contracts. And you can do it in a long position or a short position. So this is just an example of a hedge here. I'm going to skip over this. Okay, so if you want to be writing a contract, that means that you are selling these contracts to other people and you are collecting the premium. But you have an obligation. Because you're collecting that premium money, you have to fulfill the rights of the contract. So it could be easy money to make money writing contracts as long as the stock prices are moving in your favor. If you start writing contracts that are in the money, that's a little bit more riskier. There's a higher chance of these contracts being able to be traded. And naked calls means you don't have the asset. Covered calls means you actually have the asset before you write the contract. I guess you would kind of say, like, if I was writing contracts to buy Xboxes and I own no Xboxes, I'd have to actually go to the store and buy the Xbox first and then give it to you. So if I had already pre-owned the Xbox, hopefully owning them at a lower price than I'm writing the contracts for, I would be a lot more safer and more covered, and that's why I call them covered calls or covered options. This we're going to talk about in the handout when I go over the handouts. So if you want to do a little spreading, basically a spread is sort of buying a combination of options. You can do a vertical spread, which is buying a call at a strike price and then writing a call at the same strike price for the same expiration date. But you write at a higher strike price. You can do a straddle where you're buying a put and call at the same time. So the idea is if you had a stock that was trading at $50 and earnings were going to come out and that stock was either going to go to $60 or $40, you can buy a put and a call. So no matter where the stock goes, you're going to make money. So maybe it's a biomedical and the FDA is going to come out with their regulations the next day, and the stock's either going to go up $100 or go down $100. So buying a straddle will help you take advantage when you're not quite sure. You're sure the stock price is going to move, but you're not sure if it's going to move up or down. And of course, you can buy stock options on indexes. So if you wanted to buy a stock they have a stock option on the S&P 500, the Dow Jones, the NASDAQ 100. So you can easily, buy these stock options, not just on a stock, but they also write them for indexes. And stock index options are basically the same thing as a stock option, but they just write them on an index. And the price behavior is the same as regular options, and it could be used. The advantage of this is that if you write these stock options on the S&P 500, it could more easily cover your whole portfolio to large sections of volatility. So, and you can also use it to speculate on the market in general. So if you don't want to speculate on the individual stock, you can use these options to speculate on the entire market. Other types of options, they do have stock options on exchange traded funds and on interest rates. On currencies, You can write option contracts on different foreign currencies, and large companies do this. So if you're a large company and you're going to make a lot of money in euros, you may want to write some contracts to hedge your positions in the euros. And we talked about leaps before. If it's longer than 3 years, then we would actually, if it's longer than 9 months, but definitely it may even extend out to 3 years. These are what we would call a leap option, long-term option. Okay, so that's chapter 14, and I've covered the basics of options and talked about options in general and how they work and how you can trade them, the difference between calls and put options, the difference between being a buyer and a writer, and the different markets they trade on. So at this point, options is actually a pretty confusing chapter because it's not something you're used to. Stocks you know about, you're used to, you've heard about them, you've seen them change in value, but options are probably new to most of you. That's why I can't stress how important it is to read the chapter and get to understand stock options even more, and maybe listen to this lecture a second time after you read the chapter, and a lot of the stuff that you may be confused on will make more sense. So that would be my advice. Okay, take care and thanks for listening.